I want to introduce who we've got in this fireside chat. I think it's good to understand what we deal with and how we go about it. Obviously, Jim, probably the forefront of our investment committee. I think that what he does for us, he gives us perspective. He's worked with, I hate to say much bigger firms than us, but more money. And I can say that, you know. So Jim is a CFA, CMT, and AIA, not CIA. So we don't have to hide it from everybody. It's not a secret. But let's get into this a little bit. Jim Warren, Chief Investment Officer for the Wealth Consulting Group. Prior to being with the Wealth Consulting Group, he worked with a portfolio management company, LPL Financial, which, by the way, totally underwater now. That's since Jim left. We don't want to go and see their counsel. But they were managing about $15 billion before he left. I'm sure it's much less now. I'm sure it's much less. Okay. Jim's a chartered financial analyst, which at the end of the day, I got to tell you, is excruciatingly hard thing to do. I can tell you that Chris looked at that and no, I don't want to do it. And anybody knows Chris is working with Chris. That's tough. Let's see here. He's a chartered market technician. He's also a chartered alternative investment, which, honestly, whenever in trying times that we're dealing with these days, you hear a lot of people talk about a lot of different strategies and ideas about getting away from market volatility. Having somebody that has a designation that knows what to look for in those is imperative, because I'm not going to say snake oil, but I think there's a lot of different things that are out there that can really mess things up. And I think having somebody that knows alternative investments is vitally important in those periods. He's earned his Bachelor in Science in International Business Management from Brigham Young University. But let's be clear, he's smart enough to know not to do it. He went to Hawaii for this. Yeah, totally. No, Brigham Young's great, but Hawaii's way better. So, prior to college, Jim served to mission with his church. And he's to golf. So, congratulations. I can barely get English language down. You've got a couple of them down. Jim has more than 24 years of professional investment experience. He loves nature, reading, writing, hiking, good movies, and going to the lake, river, beach, anything that his family likes to do. He's just a true, genuine family man, which I love having him around. Chris, on the other hand.
I've got my church about.
Turn it off. No. And with Chris Brand, Dr. Rand, I think he makes me say it, Dr. Rand.
You're the only one required to stand up.
CFP and also a chartered life underwriter, which is fantastic. Additionally, in the industry, that was probably one of the biggest, highest earners we could get back in the day. He's managing partner for both FIDES Wealth and also the Wealth Consulting Group. Chris lectures both at San Diego State University. Let's keep our rent for Saturday, people. Let's go. Okay, that's a very fact. Definitely took out Hawaii, but yeah. Also teaches at Berkeley, which I don't know if you know about. They're really good at it. They're really good at it. So that's a good deal. Let's see here. He's also doing the capstone. Yeah, he's doing the capstone for the book. Chris holds a PhD and retirement planning, a PS degree in state. Right? So that's fantastic. Also, Chris has 3 children, 3 daughters. I understand that problem. It's part of my Brady bunch of 3 daughters, so that's good. And also there's my parent who actually attended what's on it. So God bless him. So today, guys, what I really want to get into is some of the things that we hear a lot of people in our meetings. Everybody talks about all the different things that are going on. So the point of today is to really get involved with some of the interactions we've been having with clients, and I wanted to get the perspective of an analyst, and also wanted the perspective of a really at the end of the day behavioral finance guy, which is Chris. Obviously, anybody who works with Chris knows that he gets way past behavioral finance, but I think it's important to understand how it's articulated to their clients. And so I want to be able to kind of venture into both of those perspectives for everybody today, and we can dive into it. You guys ready? Want to do this?
Yeah.
All right. So let's start with the first one.
Hold on, we got a few slides we're gonna go through first, so.
Do we want to do
Take,
slides?
yeah, take a step back there. So we're gonna. I know you. We'll do the first slide here, but when we were thinking about this event, you know, the banking crisis started, what, 3 weeks ago, I guess now. We thought it would be relevant to maybe go through have Jim talk about a few slides that he presented to our organization about a week ago. And I picked these out. I thought they would be relevant for the group out of about 50 slides that he went through. And so hopefully they're not too technical, but I thought it would be a good starting point. And then we'll go ahead and jump into the questions here. So take it away, Jim.
Sounds great. Thank you. This is wonderful. What a beautiful evening, beautiful view. It's great to be with you and great to be with Dr. Rand here. So prior to a couple of weeks ago, we only had 2 questions really that investors were asking. Are we going to have a recession and will inflation go down? Now we've got 3 questions. Will there be a run on the banks? So we'll get into that. We'll also address these other 2 questions. Will we have a recession? And when will inflation come down? Will be the other one. We can go to the next slide. There we go. So people were asking, you know, why are we having this issue with the banks? And a lot of people are scared. This happened with Silicon Valley Bank, Signature Bank in New York. So there was some challenges here, and let's just kind of dive into what happened here. So if you remember, March of 2020, we have that pandemic, and the Federal Reserve did what? They took interest rates all the way down to 0, and they tried to backstop the economy with, you know, plenty of liquidity. They wanted to make this something that we got through very, very quickly. One of the things that they did is they removed the requirement for banks to hold reserves. So before COVID, the reserve requirement was 10%. They moved that they shifted that to 0. And then during this period of COVID, the pandemic, we had all this money coming. So there was a lot of people that were collecting checks. A lot of money was people weren't going out and spending. So a lot of money was being saved. A lot of money went into the bank. So there's more than $2 trillion that went into banks. Many of these deposits were not, they were above the FDIC insurance limit. And then the banks themselves were not lending a lot of money. And so they were trying to take the assets that they were managing and the deposits that they were managing and buying securities. So this was not like what we saw in 2008, where there was a lot of low quality and derivatives and packaged up mortgages. That was kind of scary back then. This was all very safe instruments. These were treasuries, mortgage-backed securities, things that were safe, but they bought them when rates were really, really low. And subsequently, rates went much higher. So that's how we got here. Next slide. So this is, you can see here how much balance sheets grew. This is a slide from JP Morgan Asset Management. You see Silicon Valley Bank, their balance sheet grew by 250%. Signature Bank of New York was more than 100%. But you can see here a lot of them have 50%, 100% growth in deposits. Next slide. And so this is the amount that was uninsured. So deposits that were above $250,000. And so think of Silicon Valley Bank. What do? They meet with a lot of venture capital firms, startup firms, businesses. And these businesses were putting in much more than $250,000. In the case of Silicon Valley Bank, 90% of their deposits were above that. But you can see a lot of other banks have that too. You know, more than 50% had more than 250,000. Next slide. And so this is just a chart showing interest rates. And that gray box that you see there, this is when these banks started buying treasuries. They started buying when treasuries were yielding 0.5% to 1.5% to 1.75%. And they were doing that, not knowing that the Federal Reserve was going to be raising rates and that the 10-year treasury would eventually get to 4%, above 4%. So this was not the right time to be buying those. Next slide, please. And so here we are today. If you look at, where we're at 2022, everything on the far right here, these are those bonds that they bought, and this is how much those bonds are underwater in terms of unrealized losses. So the blue bar just means held to maturity. These are not required to mark to market. They're not required to value those on a regular basis on the balance sheet. Available for sale securities, they are for the larger banks, but the whole point of this is just to show that these things were, because they were purchased when rates were really, really low. When rates went up, what happens with bonds is when rates go up, the value of the bonds goes down. So that is what the challenge has been. And with technology, think about Silicon Valley Bank. A lot of these technology companies were having a hard time. Last year was a tough year for technology. There's some layoffs and there's some cash crunches. And so rather than adding more in deposits, they wanted to start withdrawing money. And so that's how this started. Next slide. So what are the regulators doing? So right after this happened, we saw that the Fed, the Treasury, FDIC all came out and had a joint statement, a letter that's saying, we're going to insure all of the deposits for Silicon Valley Bank and for Signature Bank of New York. And, that was very, very good for those people that had excess capital there, the companies that were funding a lot of small startups, but they didn't come out and say this is blanket for everyone. So that's what kind of triggered some of this concern with some of the banks. Then they came out a few days later and announced a bank term funding program that would say, okay, all of those underwater bonds that had unrealized losses, we're going to let you borrow from us at par. So if the bond, let's say, is worth 70 cents on the dollar, we're going to let you borrow at 100 cents a dollar. So if people are taking money out, you'll have all that money to give them. So that helps quite a bit. And then you have a group of large banks, the largest banks, 10 to 15 banks all came together and they lent First Republic $30 billion to hold on deposit to help with their clients that want to take money out. And then the last thing here, central bankers around the world started coordinating their efforts. The EU with the ECB, the Bank of Japan, Bank of Canada, the US Federal Reserve, they all started kind of working on this. So where we're at now is like, there's still some question about it, but a lot of this is just people are fearful of it. And so people are moving their deposits out of banks into brokerage accounts, buying T-bills in some cases. In some cases, they're spreading their money out to make sure that they've got enough. But we're confident that this is all going to get resolved. These things are, this is not something like the financial crisis where it took a little bit longer to figure out. It was a lot more complex of a situation. So next slide here.
Let me jump in there real quick. So I think something that's important to get across is that this is very different than the 2008 financial crisis. You led into this a little bit earlier on, is what the banks owned during the 2008 financial crisis were, I don't want to call them worthless securities, but there were securities that had 50% of the value and just weren't going to come back. What the banks own in this case are treasuries.
Yeah.
And as long as the treasuries are held to maturity, it's a 100% guarantee the value will come back. And so when the Federal Reserve loans money to them to cover the difference, it's basically bridging them to be able to hold the asset long enough to get back to the point when it comes to par, which will slowly happen over a number of years. So there's really no risk, if you will, that bond is not going to be worth something in the future. It's probably the right way to describe that. And I think that's why this time is very different than the 2008, 2009 financial crisis. Is that accurate?
Absolutely, absolutely. Yeah, 2008 was such a, there was a lot of bad players in that type of situation. You had banks, you had the lenders, and you got subprime loans, and probably heard of the ninja loans and job
Liar loans.
liar loans, and then a lot of those securities got packaged up and repackaged, and sold, and it was bad. And you had a lot of insurance that got tied up into it. So this is totally different than that. But I guess the one common thing is there's fear. And whenever there's fear and people feel a little unsettled, you feel like, I don't know what I'm going to do. Do I need to take my money out? Do I need to move it somewhere else? And so I think what regulators are trying to do now is to calm down those fears, get it settled down, and help people understand that we're going to get through this. We've been through crisis before. We'll get through this. You can go to the next slide. So a lot of people are talking about, we're going to have a recession, and sometimes we hear in the media that things are really, really bad. But the reality is the unemployment rate is very, very low. It's ridiculously low. The lowest it's been in several decades, right? And part of that is because there was a number of people that during COVID, during the pandemic, they left the workforce, and some of them took early retirement. Some of them, had some disabilities where they were sick and they just wanted to take some time off. But those people, are not in the labor force. And so you had the situation where there were 2 jobs available for every person looking for a job. And we still have that situation now. So typically, when we do have a recession, we always see that the unemployment rate spikes. I don't know if you can see the pink lines there, that those are recessions. And every single time we've had a recession, the unemployment rate is spiked higher. We just have not seen that move up. It's kind of moved sideways a little bit, but it's still, you probably don't see the very, very super skinny pink line there. That was the recession that we had during COVID. And you can see that shot up to 15% almost for unemployment, but guess what? It came right back down. Next slide. And so this is just showing the labor force. So the labor force has actually been declining since kind of the early 2000 period. People have been retiring earlier. In some cases, there's been someone staying at home, a stay-at-home dad or a stay-at-home mom that's doesn't need to work. And so that's come down, and then it was coming back up. It was starting to move back up, and then you can see that sharp spike downward. That was the pandemic. And what were people doing? They were just at home. A lot of them were unemployed, and you can see that everything started back up. It's kind of like a computer rebooting, right? And so people have been coming back into the labor force, but it's still not where it was. There's still about 5 million people short from where we were before COVID. Next slide. And now here we can see the inflation number. This is the inflation figure that the Federal Reserve looks at, the PCE, the core PCE, personal consumption expenditures. And that's the yellow line there. You can see that was moving higher in the beginning of 2021. Then it moved a lot higher, and it just kept moving higher. The blue line is the federal funds rate. So that's the interest rate that the Fed charges, banks for lending, and they kept it at 0. And what were they saying? They were saying, it's transitory. This is a nice word for temporary. All this inflation is temporary. It's all going to go away. And to be clear, a lot of people thought that it was temporary. We had, a situation with wages, there weren't enough workers, and so people want to get paid more. We had supply chain issues. If you're trying to, well, for a very short while, people were trying to buy toilet paper, right? So people were worried about that, and then there was other things, and used cars went up in value, and so we had this inflation. But guess what? It kept going. It kept going while these things were getting ironed out, and then guess what happened? We had Russia invading Ukraine, and Ukraine supplying a lot of food, and Russia and Ukraine both supplying a lot of energy, so that made commodity prices higher. And so this inflation just kept going higher and higher, and then the Fed finally started saying, okay, we're going to raise rates. But it was not a very gradual raising of rates. It was pretty steep. You can see the blue line there. They raised, and they said, we need to go raise them higher and higher. And so now we're at the point where rates are about where inflation is when we look at PCE. And so the argument would be, well, do you need to keep raising rates if you're where inflation is? And a lot of people would argue, no, you don't. You can go to the next slide. And so final thoughts here are that we believe that inflation is coming down. It will continue to come down. Some of these things regarding inflation for housing, it's taking a little bit longer. Now, if you look at the cost of buying a home versus the cost of renting, that spread between the two is widened substantially. And so that's going to discourage people from buying a home. Home prices are already starting to come down. And so that is going to make its way into the number that the Fed looks at, the inflation number. And then they're going to say, this is something that, inflation is coming down. So the other question is like, will we have a recession, right? So when we look at all of the data that, we're seeing, whether it's unemployment, whether it's growth, whether it's earnings, all of these things, it still looks like we'll probably avoid a recession. Probably about a 30% chance that we have a recession. But the Federal Reserve is likely going to pause, and then they're going to start cutting rates, especially in light of what we're seeing with this banking crisis or challenge that we're going through. Unemployment, as we mentioned, is still very strong. This could weaken, but it's still good. It's still in good shape. Earnings and margins have come down, but they're still good. We are not having across the board all sectors where earnings are falling dramatically, profits are falling dramatically. So that's a very good sign. And as I mentioned, inflation is going to come down more when housing comes down. So we still see a soft landing. What that means is it just means that economic growth is going to be lower. It might feel a little bit like a mild recession, but we probably won't have a recession. And I believe the Federal Reserve would like to regain some of their credibility that they've lost when they waited too long to raise rates by looking at the situation and saying, okay, well, with these banking challenges, we need to be very proactive here and a little bit more cautious.
Yeah. Add one thing. So when you say soft landing, Jim, so I'm going to be on a Southwest plane on Friday, and I know you flew in on one today. And so usually, if it's a Navy pilot or an Air Force pilot landing, is this an Air Force pilot landing or is this a Navy pilot landing?
I don't know the difference between the two. It's going to be, you'll be able to have your tray table open and the cup on the, well, they say not to have it open, but it'll probably not knock over your.
So that's Air Force
cup of
landing.
water. That's Air Force.
Yeah.
landing. So it'll be an Air Force.
And the
landing.
Navy pilots get, they think they're landing on aircraft.
Navy, yeah. So I don't believe the worst would be a crash landing, right? So the crash landing would be very bad recession, lots of unemployment, profits, go down substantially. I just don't see that happening with all of the data that we're seeing now. Manufacturing is slowing some, but we're just, we're still seeing consumers are spending. Now, if they get scared, because they're worried about banking and they start spending a lot less, that would be an issue. So 2/3 of the economy is the consumer. Great question.
I mean, at the end of the day, I mean, the Fed wants us to just slow down spending, right? And don't stop. But if you look at it, I mean, I think we all know personally, when you go to the stores now, you're starting to see sales, which is a good sign that we're not recessionary, but our supply chain is heating up with, with everything versus, I remember in the middle of COVID, 2021, I needed a couch, all the couches at that point, right? We're sitting there. And I tried to buy it. I remember saying, I want to buy a black couch. Nope. So we have a light blue couch now. So, and so I think that we're just getting back to that point in time where the supply chain is starting to catch back up with the demand chain. And I guess we're a little competitive in the day trying to match that up, which I don't want that job. I don't want that job at all. But what job I do want is ask this questions. So, and I think you kind of addressed it, but I really wanted to get into it. How scary is the current banking crisis? I mean, where's your head with your thought process on this right now?
It's a great question. So, like, on the scariest level, if I'm going to rank this like from 1 to 10, the financial crisis was like an 8 or a 9 or a 10.
It was up there.
This is probably like a 3 or 4, to be honest with you. And it's only scary because when people take all their money out of the bank, and the bank doesn't have, those deposits, and then the bank starts struggling, and then is there another bank that starts struggling, and does the government help, restore confidence?
Right.
So, and I think they're making the effort to do that. They're taking steps to do that, and it's going to get resolved. I would love to tell you that it's going to be all resolved within like a weekend, but like we're not there.
It's not the Great Depression.
It's not the Great
It's not the Great Depression where people could not get money.
That was scary.
That's scary. Now, Chris, we're going to take it over tone, right? Your job here is to talk a little bit about the client impact. So with the bank crisis, what are your thoughts? I mean, when you articulate to the clients, where's your brain at?
Well, first, I would agree with Jim. I'm not nearly as concerned about this cycle as we were in 2008, 2009. Probably used similar numbers as far as the ranking. Something we've been telling clients for a number of months is that, we're feeling comfortable. There's not a credit crisis. And then we had the initial thought of a credit crisis. That was scary, frankly. The thought of a run, there's almost nothing scarier in my mind to a run on the bank. If everyone pulls all their money out of the bank at one time and all the different banks, we're going to have a real problem. But the good news is that we found a way to go ahead and stave that off. We believe that these are anomalies. The three banks one another are anomalies. It's not a contagion. But what we do tell clients is, be smart about the money that you do have in banks. Make sure that it's FDIC insured. 250,000. That's the limit. If you're sitting here wondering what on earth is the FDIC limit, it's $250,000. It's $250,000 per account type. If you're unsure if you have money in the bank and just chat with your advisor on how best to set that up. The challenge really in my mind is businesses, and they'll figure out some way, regulatory wise or whatever over the next few years to deal with that impact. Because if a business has their capital account $10 million to cover payroll, and they're only insured at 250,000, that's basically what happened with Silicon Valley Bank, is my understanding. That's the challenge. Our clients don't have $10 million in the bank. They have within the FDIC limits, can spread that out pretty well. If you have over that you want safe, there's other ways to keep that safe. And so I think that from a client perspective, things are quite well. You never know for sure, but I would say sometime relatively soon, it'll be clear whether this banking crisis is going to get worse. And we're not seeing that right now. So my guess is we call it a 3 now, slowly getting down to a 2.
I mean, obviously, we hope that it's kind of isolated to those kinds of Yeah, I mean, Silicon Valley, it's no secret, they had a ton of venture capital money and startups and everybody, that's where all that money is at. And so to think that they're in a situation now where, okay, that money's not as readily available, makes sense. So let's go to the next big question. Rate hikes. Where's your brain on this? What's your thought process? Is the Fed going to raise? Is there going to be one? Where are we at?
Another fantastic question. So,
That's why I asked the question.
they just raised by 25 basis points. I think they might raise one more time between now and May. And I don't know. I like, to be honest with you, I don't like all the people on Wall Street are looking at this. There's Fed funds futures that are pricing this in. And most people are thinking that they may raise one more time and then, things will kind of taper off and they'll start cutting rates.
Don't read ahead to my questions. You do not get bonus points for reading ahead to my next question. But the next rate cuts, right? That's always the thing, right? I mean, in my experience, I've seen the rate, the government traditionally will overdo it. And
Yeah.
realize, maybe we did a little too much. Let's pull back. I mean, what are your thoughts on that? Do you think that that's likely? Do you think it's likely this year? What do
I think it can start this year. I think that just because of what happened with raising rates too late and then raising them too quickly and the credibility that the Fed has going back how many decades that every time the Fed hikes too much, they always break something. Something gets broken, like some banks.
Yeah.
Or some other companies that got too much leverage. So I think they're going to look at this as an opportunity to regain some credibility, to pause. But we're going to have to look at the data. If we start seeing inflation come back,
right.
I don't think we will.
Right.
But if we do, then the Fed can say, well, we're just gonna keep rates higher.
Powell's in here right now. It's so very similar to the most recent testing. Okay, so it's good. No, but I mean, that's real, right? I mean, the whole point is obviously you push it, you want to stop the economy from growing at the speed it's growing, and then there's a little bit of pullback. Yeah. How do you think the markets react in a situation like that? If we realize at that point, at the end of the day, hey, we pulled back, we went a little too aggressive. I mean, do you think the rate hike is priced into the stock market right now? And if they're going to do it, do you think they're going to pull back? I mean, how do you feel that works?
It's a great question. Again, I think some of the gains that we've seen, particularly in the areas of technology, consumer discretionary, and there's some momentum there. Those areas certainly seem to be pricing in the probability that the Fed is closer to the end, and closer to the end meaning they're not going to hike anymore, and also pivoting, which means that rates would come down. Now, if you look at the actual markets, especially like the 10-year Treasury, that's come down significantly, and so yeah, I think the markets are partially pricing that in.
Right.
I don't think they're fully priced in, and if the Fed in their next meeting says we're going to pause, and the meeting after that says they're going to cut, then I think the markets will probably perform pretty well.
Right.
If they come out and say we're going to hike a lot more, probably not be good for markets.
Maybe Chris, you can get into this a little bit further, right? I mean, obviously, when we start talking about markets are priced in, this and that, it's going off script. That's what I do. When we talk about the market being priced in, how are you bringing that to the client, right? I mean, what does that mean when it says priced in or not priced in? I mean, when the market looks in the future, how does it kind of articulate that through the growth and the decline in the market?
Yeah, so the market tries to tell us where interest rates are going to go. And so like Jim was talking about, one more interest rate increase, maybe arguably a second one, maybe already priced in. So if we get an interest rate increase in 30 days or 60 days, that's expected. And you wouldn't expect the stock market to sell off or the bond market to sell off, because that's what's already baked in or priced into the current pricing. Where it becomes an issue is if they announce that 0.5% or 3/4 more, the market was not expecting that. It's not priced in. And so you would expect that the markets would sell off. I think it's a safe statement to say that we're a lot closer to the top than the bottom of the interest rate increases. If we went back a couple of slides, you can see, where we went from 0 to 4.75. We're trying to figure out what the Federal Reserve's terminal rate is, which is the highest rate that they hike to. So that might be 5, that might be 5 1/4, but we're going to get to that terminal rate. I think a more relevant question, maybe for all of you in the room, is, well, what does that mean to me? If you are invested in all in bonds over the last year and a half, you saw losses in the bond market, just like we saw in the stock market. That's not normal. We normally don't see the bond market and the stock market falling at the same time. And that was because of the rises in interest rates. But as soon as interest rates levelize and they start to go back down, that's where bond markets will go ahead and recover. But maybe how do you take advantage of this would be the way we think about it for our clients at this point, is if we believe, as I do anyway, and I think Jim's most of the way there, that we're a lot closer to that point. Being the analyst, on the economic side, he's always on both sides of the fence. He has to play both sides. We're a lot closer to that, and you're saying to yourself, hey, I've been sitting on the sidelines and I'm thinking about, getting back into the market, or I want to increase my risk a little bit, or anything along those lines. We're just a lot closer to that point where you could do that safely, I guess, would be one way to say that. And then secondly, if you've got money in a bank right now, and I know many of our advisors have talked to our clients about this, and it's sitting in a savings account and it's earning 0%, because that's what a lot of banks are still paying. You can get CDs, you can get treasury bills now that are higher than that. And you got to lock up for 3 months or 4 months or 6 months. But that's a great opportunity to talk with your advisor about, hey, I've got this money I want to keep safe, but I want to take advantage of, our short-term interest rates. How can we get a better return on the savings money? Mark and I chatted a while ago with someone he knows very well in the banking sector. We couldn't figure out why on earth savings rates aren't going up, and it's become clear, and I won't go into the weeds with you guys on what we learned, but they're just not going to go up anytime soon. We're going to see increases in CDs. We're going to see increases in treasuries, which we have, but we're probably not going to see big moves at least in short-term savings.
So basically, no 1099s for your savings accounts still.
But you might actually get one. I mean, last year I paid a little bit of interest. You joke about it, but you don't get a 1099 from your bank. It's a lot of money because they were literally paying nothing. And you only get a 1099 if you're in $25 in interest. And so it'd be uncommon to get a 1099 where you're finally starting to receive that. And that's maybe the upside to where we're at today with the increase in interest rates. It's something, if you can't tell, it excites me a little bit. And I'm excited about the thought that we're going to get yield finally in the bond market again and in the short-term debt instruments. And we're probably not going to stay here. Hopefully not going to stay at, a terminal rate of 5%. Maybe we lower down 1 or 2 or 3 quarter-point drops. But we're probably not going back to 0. And so that means that our retired clients are going to be able to invest a little more conservatively and get that fixed interest rate return. That's something that's getting a decent yield as opposed to having to take more risk.
Fair. But now the reason people leave money inside bank accounts and CDs and things of that nature is because they're worried about recession. Jim,
Fair?
maybe we can talk about recession. And what does that look like economically? I mean, how does that intersect? I can't tell you how many times I watch CNBC and they're like, "Oh, we're in a recession," or "No, we're not in a recession." I mean, when you as an analyst look at a recession, what do you look at? How do you do it?
Yeah, so it used to be a few years back that when we had 2 consecutive quarters of negative GDP growth, that was the definition of a recession. And since then, the National Bureau of Economic Research has, come up with their own formula that's a lot more formulaic, looking at all these things, but they're going to look at employment, they're going to look at industrial production and manufacturing and growth, they're going to look at corporate profits, and so some of the slides I showed a while ago with unemployment being this low, I don't think right now it looks like anytime soon unless we have a lot of layoffs and a lot of small businesses that have a hard time. But the yield curve is inverted, and that also is looking like it would be a recession. So they're conflicting. There's some conflicting signals here. I would say that by the time we learn that we're in a recession, we're probably already on the way out of it. So, because they're going to come back and the NBER is going to say,
Oh, yeah.
we're in a recession as of 3 months ago or 6 months ago.
Right.
And the market may have already bottomed. Most likely the market, will bottom before the recession. So
And that's honestly where I was going with my conversation is, so many of us, I think most people, when they think about recession, they think of 2008. Would everybody agree when you think about it, you think 2008, how common is 2008 in our economic cycles? Not common at all. It's black swan, right? It's the worst possible conditions matched up with the worst possible conditions. Blah, 2008. It's a perfect storm. So is it safe to say that does the market bottom in a recession? I want to get your opinion as an analyst. I want to get Chris. I want to get your opinion as an advisor when it comes to how mentally get through, right? Because so much of it's mental, and so
You want to talk about?
yeah. So why don't you talk about it first?
yeah, so your question again was, does the market bottom in a recession?
Yes.
Or a recession? I would say it's going to be before the recession. We don't know that we're in the recession. Yeah. The good news is by the time we learn that we're in a recession, most of the bad stuff has already happened.
Like you weren't speeding before the cop pulled you over, but this we catch you.
Yeah,
Yeah.
that's right. Now, it's going to depend on the length of the recession, right? So if it's a long, drawn out recession, the market could go sideways for some time. But like even with 2008, as bad as that was, and you say that was very, very uncommon, which it was extremely rare. You had the housing market, which collapsed. You had all of those instruments, those bond instruments and derivatives that were tied to the housing market, and those were tied to the bank, and those collapsed. It was a global issue, but we bottomed March of 2009. That's where the market finally bottomed. We saw that things were starting to get bad at the end. I believe it was September 2008. So there was a few months, but it did bottom, and then it came back. So that was actually the very best time to be buying the market.
It didn't feel like it was done right.
No, it didn't.
Really hard to convince people to move in that situation.
The biggest thing I want to get across, if you're a client, and trust me, this is going to happen if we get a recession. I'm not saying we will, but if they call a recession, it's going to be headline news. It's going to be, every time you turn on the TV, oh my God, we're in a recession. This is going to be bad. People are immediately going to remember how 2008, 2009 was. You're going to be tempted to call us as your advisors and say, we're going into a recession. Do we need to pull out of the market? And what Jim was just alluding to is, hey, the market already bottomed. This is not a time you want to pull out. That happened. The markets are forward-looking, and so investors are looking 12 months or 18 months out. And if it's going to be a relatively mild recession, which is our house view, it would be short, and the chances are relatively good that that market has bottomed out. The question is, how mild would the recession be? But I think the important thing to know, and trust my words, this is going to happen. If they call it a recession, everyone's going to really panic, and it's going to be headline news, and everyone's going to cover it. All the media channels are going to cover it, and that'll be the topic for a couple of weeks, and it's going to be scary. And it's probably not going to happen for a few months, would you say, at the earliest? If and when we get that, if they do call a recession, we'll be at that, at that stage. And so you can remember back to this meeting that we talked about it, and we told you, don't panic. That's a good indicator. I'm excited personally as to where we are now. When we think about Federal Reserve, in my mind, you mentioned the term Federal Reserve breaks something when they do interest rates. And I've been saying that a lot lately. I'm excited because frankly, I think the Federal Reserve has the best evidence they could possibly imagine if they broke something. And that would be the banking sector a couple of weeks ago. And so that seems to me to be a lot of good evidence that maybe we're there. And we're starting to get to the other side of that.
Trust you, was emails to see Graham. All right, so let's go up the Yep, let's talk about 2023. We are not officially done with the first quarter, but we're going close. Yeah, how do we feel about Q2, Q3, Q4? Where's your outlook?
You know, I'm actually feeling more confident, even notwithstanding the banking challenge that we're having, I'm actually feeling pretty good. I'm feeling better now than I was in October, November. I think that because the Fed is getting more data and, they can see that inflation is coming down, we're starting to see some of these sectors come back to life. In technology, what's happening in AI is incredible.
It's crazy.
And, I think that's going to help a lot of people, a lot of companies become more productive. I don't think it's scary at all. I'm optimistic. I think, if we get 8 to 10% return, that could be very, very easily done. Now, if the Fed cuts rates sooner and, we kind of dodge the bullet with banking and we don't, have a drop in corporate profits, then I think we could do 10 to 12%.
Okay.
And this, by the way, this is also a rare opportunity where both stocks and bonds can both do well. So last year was a really, really bad year where they both went down together. It's super rare for stocks and bonds both to go down. And so I think because they can go down together, they can go up together this year.
Dr. Rand, what's your approach on 2023? What do you tell the young minds? The young
You know, I sit on the
minds
same
today?
committee, we're both, executive team members of that, so, but I feel the same way. I'm optimistic. I feel much more optimistic than, like I mentioned a few minutes ago, because we've been looking for evidence that things are slowing, that something's maybe, broken, and that we're getting closer to that.
Okay. So now let's change it over a little bit for you, Chris. Because I know you like to get into the weeds of government and political process that's happening. Let's talk about Secure Act a little bit. Okay, I don't know, everybody's been watching the news, all the new rave out there. What do you see coming out of Secure 2.0?
Yeah, so if you were unaware, Congress passed a law like they like to do right between Christmas and New Year. And so they kind of drove this through. I think it's mostly positive with this one big negative for me anyway. So Secure Act 2.0 is designed to add additional benefits to promote retirement. And so I don't know that there was a lot of negative things, frankly, other than the one thing I'm going to mention that came out of Secure Act 2.0. It's mostly positive. So if you are close to the age of 70, 71, and you're thinking, I have to start doing this thing called an RMD, a required minimum distribution. It's a certain amount of money that you have to take out of your retirement accounts every year. That used to be age 70 now. That became age 72 a couple of years ago. It's now age 73, so we're pushing it another year. Now, if you're already 72, bad news is you have to continue to take it. But if you're not there yet, it's now 73. And I forget the year exactly, but a few more years out, it goes all the way to age 75. So that's a lot more flexibility for those that are retiring soon to not be forced to have to pull money out of your retirement accounts. Doesn't mean you can't, obviously, you can take money out, it's your money. You're 59 and a half, there's no penalty. But it'll eventually be age 75 start earning. So that's a positive.
Which makes sense. People are living longer. I mean, the whole concept of the 70 rule of 70 or the 70 and a half was life expectancy. I mean, hell, when they put that together, people are living to 80, 81, so. Yeah,
and well, a lot of people ask us too, why on earth do I have to take my money out of my retirement account if I don't want to? And frankly, the government gave you a tax benefit for the last 50 years and they want their tax money. That's the bottom line as to why that is. And so they require you to take out a very small percentage on an annual basis. The good news is that's now going to be age 75 over the next couple of years. This is for our those that are still working. And I was going around the office in January and I was super excited. Not that I'm going to be turning 50 this year. That wasn't the exciting part. The exciting part was, because I'm turning 50, I get to do something called a catch-up contribution. I can put more money into my retirement account. So I started doing that. I was super excited. And then I read the verbiage of Secure Act 2.0 and they took it away next year. So I can put more money in, but you cannot get the tax benefit. And it's for if you earn more than $145,000 a year, which is not a lot of income. So not accurate, yeah. So they're still trying to interpret, the IRS has not come out with regulations yet to interpret the laws. It's very normal. It'll be a while before we hear this. But what do they mean by 145,000? Is it wages? Is it adjusted gross income, which for a married couple would be a really low number? Is it taxable income? You know, so we're going to find out what they mean by that. And so stay tuned. You can do it this year. So if you're over 50, you're doing catch-up contributions for the benefit of tax benefit rather, you can continue to do that, but be aware that starting next year, that is, unless they change something, that's going to go away. There's a really cool benefit that came out of this as well. And that was the ability for those that have 529 accounts for their kids that didn't spend the money on college. There's a lot of people that were maybe in this boat. Their kids didn't go to college, or they had just saved too much money in the college accounts. And now there's this money left over, and they're looking at it with the only option to taking the money out and paying taxes on the road and an early distribution penalty. So starting next year, Amber, next year, right? Starting next year, so this isn't here yet, but starting next year, you'll have the ability to roll some of that money into a Roth account. And so it's a way to say, okay, we'll keep the tax-free treatment. We'll now, you know, in essence, change it from that college account to a retirement account. So that's pretty exciting. Lots of bipartisan support on that.
So I have to incentivize the children to join the Roth family, so I can make my Roth.
Sure, that's what you want to do there. And then, you know, none of our clients will do this, but if you forget to take an RMD distribution, there's a massive penalty of 50%. We're really good every year at making sure our clients take them out. That's something we start in November. We call everybody, we check, make sure it goes out. But if you didn't, starting next year, or starting this year rather, they've reduced the penalty from 50% to 25 or even 10, depending on the scenario. So that's another positive piece to that.
All right. Now let's get to the tough stuff. Let's get to the tough stuff, Jim. We have a small density issue. That's a lot more listening to it. What are your feelings on this? With higher interest rates, where are we at with that? Let's start with debt ceiling and how you feel about it, where we're at there. And then I want to kind of parlay that into with the higher interest rates, how's that going to affect the federal budget? So it's a 1-2 punch.
Yeah, so with the debt ceiling, you know, we go through this, it seems like every so many years.
Yeah.
And they shut down some parks. They closed some beaches. Hopefully they didn't do that here. I don't know what happened here, but like that's something that unfortunately there's some political theater.
It never runs better.
What's that?
It never runs better.
Yeah, I think we're gonna work together. You know, there's obviously major consequences if we don't do something, right? The consequence of not acting is a lot bigger than if we act and maybe it's not the best solution, but you know, something that we just have to get used to. I hate to say that.
Right.
You know, we're a country that loves to spend, and it seems like regardless of which parties and the administration, like they so, you know, maybe at some point and we also have crisis. Whenever we have crisis, we typically.
So I just need to load this up. It's a conversation for sure.
Yeah, but we're gonna get through it. I mean, it's in everyone's best interest, both parties' best interest to work through it. Sometimes they patch it, and then we have to revisit it again in a couple years. As to your question about the interest rates, so this is interesting because the Treasury issues the bonds. And for a lot of the last several years, the Federal Reserve is buying bonds. And so, you know, do we have a situation? We also have other governments that are buying those bonds too.
Right.
So, yeah, we're buying the bonds. at a higher interest rates, but we're also paying the debt on it. So it does feel a little bit like a shell game
Right.
in terms of the accounting on all that, but, I'm confident we're gonna get through this debt ceiling and, they'll likely raise it, and there's likely gonna be some back and forth, like, senators will want to put something in for their.
Now, of course,
It's
it's
weird.
weird. It's a big word. Yeah. Sure.
Mark, we got about 2 more minutes.
Yeah, let me get it,
Got any other questions there?
here's, I guess, for people that are in the room that would get into what's important to them, what changes have been made in the model recently? And what is the investment committee doing about proactively managing the models and the investment? Jim, we'll start with you. Obviously things like energy, we've adjusted.
Yeah, so we owned energy for all of last year. That was something that helped our portfolios tremendously. We're also underweight technology. We've since removed that excess exposure to energy. And actually, we've started adding to technology. We've also added to real estate.
Commodities also.
Commodities, we participated some with commodities when we saw that there's a lot of momentum going into commodities with Russia, Ukraine, and we got out of that position when things started settling down.
I think something I'd add there is so on the committee, part of the active management component that we do, we're not of the belief that we should just go in and get out of the market or go in and get out of certain sectors, but we are of the belief that there's opportunities to be a little overweighted or underweighted. So that's what Jim's talking about, is we were overweighted to energy last year, and that worked for us. That was a good thing. We were underweighted to technology last year, which worked for us because technology did a lot more core, than some of the other stocks did. And so it's these tweaks that we make on a somewhat regular basis, frankly, to either add an overweight or reduce an overweight or even go to an underweight as it relates to those sectors, as we believe, our house view of what's coming up relatively soon.
I think the last question that we have here is, what are you hopefully positively about the coming year? I mean, so what are you concerned about? Where, I guess it's a tough word question, but
Well, I
what are you
mean,
hopeful?
I get-
Where are you positive? What are you looking forward to? And what's going to take this out of the current economic situation we're in? That's really what we want.
maybe I'll start with that and hand it over to Jim. So probably the thing that scares me the most is the unknown. With the war getting worse and Russia, the banking crisis stopping, actually being averted. Inflation actually continues to increase, so these are things that we don't believe are going to happen. It seems like there's a lot of evidence that we're not going down that path, but that's probably the things that concern both Jim and myself and the other investment committee members the most is, what don't we know? But I do think there's a lot to be excited about as we head into 2023. Frankly, we had a really bad year last year. What commodities were pretty much the only thing. Commodities and energy were the only things that were last year. When treasuries lose money, that's a bad overall market. But that's not typical that we see these repeat bad markets year after year. And so I am still of the belief, as Jim is, that we'll have not only a positive year in the equity markets this year, but a pretty positive year. And I don't know if you guys caught that when he said 8 to 12% positive equity growth. He also said positive bond market growth at the same time. And it's not so much that we think the bond market's going to do good, we just think it's recovering. And so the bonds are going to go ahead and probably have a relatively good run this year as well. And so combined, that could be a relatively good overall portfolio return, I guess, because most of our clients, you guys included, are well diversified, anywhere from maybe 20% in equities to 60 or 80% in equities. And so the rest of that is invested in bonds, and the gold markets are doing well. That's a good thing just in general. I'll turn it over to you.
Yeah, so the things that I guess would worry me, keep me up at night would be, does China invade Taiwan? right? That's a challenging thing to model, by the way. So even with Russia and,
By the way, he
Ukraine-
loves modeling things.
Yeah.
One of the best things we do is we'll ask him a question and, they'll come back 3 hours later with this huge model.
So some things we can't model. That would be one, and Chris mentioned all the other ones. Inflation comes back, there's the banking crisis doesn't get resolved or it gets worse. There's not too many of those things. One really, really positive thing we didn't talk about tonight was credit markets, high yield markets. They haven't blown up, and all of this. Now, we may turn on the TV and see that, oh, there's a lot of, headlines about banks, and it sounds scary, right? When you turn the TV, but like the credit markets are functioning very, very well.
We're paying the bills.
There's not like massive amounts of defaults. There's not massive amounts of foreclosures. Now, credit card debt is starting to creep up there a little bit. We're keeping an eye on it, but the high net worth, the disposable income to net worth is much, much higher than during the last couple of recessions. So people are just much well prepared. That's positive. I think, with all of that's going on with technology and productivity gains, and at some point, I think things will settle down with kind of globalization and disruptive technology, and so there's going to be more capital spending there. That's going to be good for job growth. That will be good also for trade, and those things will be deflationary. So once we can really get the Fed backing off on inflation, now I don't want to have a situation where they have to cut rates to zero, because that means that we're in a crisis, we're in a recession, and trying to get through it. But hopefully, again, it's an Air Force landing, a soft landing, and there's a lot of positive things. I think opportunities.
Job growth is good.
Yeah.
We had ended the job growth is good. It means that the economy is thriving, which leads me to one of the questions that came in, and I can only appreciate my clients for these comments. With the labor force really in the decline for the past few years, he recommended I have more children. With this, I said, no, and I can just talk to Mr. Myers. Thank you very much, guys.
So once again, I want to, how about a big round of applause for Mark, Chris, and Jim.
And we'll get that, when you do that, you have a question too. Jim and I'll stick around for a few minutes here, and happy to.
All right, well, hopefully that was informative for everyone. Hopefully you'll all be able to walk out the door tonight with a little bit less anxiety, less concern potentially than when you walked in. Because I think the overall message is overall pretty positive. So hopefully that's what you all took. So again, on a completely different note, for all of us here in San Diego, this is, I've lived here since 1996. This is possibly the most exciting sports weekend in the history of San Diego. We got opening day with the Padres, the most anticipated season, obviously, in Padre history. We got the Aztecs in the Final Four Saturday, so pretty excited. Keep your coming better. So anyway, as I said at the very beginning, this is the first time we've been able to do this since March 4th of 2020. We are thrilled to be back here tonight. We're thrilled that you all can join us. And again, thank you for everything that you do for us. And again, welcome, and hope drive safe home, and it was great having you. Thank you very much.